Welcome back, everyone. I'm Tim Jones, Business Development Manager at foreclosure.com. Today, we're diving into one of the most powerful strategies in real estate investing right now: fix, refi, rent. The step-by-step loan approach helping investors scale even in a challenging market. To break it all down, I'm joined by Rick Rall. Rick, thank you for taking the time to join us today.
Absolutely. Thank you very much for having me.
Nah, it's our pleasure. Would you mind telling the audience a little bit about your background in real estate?
Sure. I started on the mortgage side, really finance company side in 1994 with what was then known as ITT Financial. I then worked for another mortgage company, and then I started my own in 2000, or excuse me, 1997. I had that till 2011, made it through the crash, did all types of loan,
Hmm.
had my Eagle, did FHA, Fannie Freddie, VA, USDA, any iteration of Alt A, subprime, everything.
Okay.
And then got out in 2011. The crash was terrible for everybody. It
Hmm.
was good for those of us that had a good base, but it was not a lot of fun. It was kind of what did you do for us yesterday? The rules have changed today, and it just made it tough. Not just for me, for everybody, as we were, as they said, bouncing on the bottom, trying to find footing.
Hmm.
So in 2011, got out. The whole time I was a real estate agent, became a broker, and was president of a board of realtors in Maryland here. I'm still a real estate broker, but I don't operate in that realm. Um, and in 2015, a good friend of mine, who was also in the business with me, we had bought, fixed, renovated homes. We realized that there was just a gap in funding between banks and what was known as hard money. And, hard money obviously is for the asset, but it's known as hard money for a lot of other reasons because it's not very friendly. And we saw a need and said, there has to be somebody with our background knowledge between the lending side, the real estate side, title side, and real estate side that we could offer a better product. A lot of people will give us a phone call and they'll say, "Hey, you guys are hard money." So no, we're not. We are private capital. We are not in the loan to own business. We are genuinely concerned with what our clients' wants and needs are.
Hmm.
And that's really what started us. Somebody comes to us, they have a dream. We cut our teeth with fix and flip. We raised our own capital, started the company in 2016. We're going into our 10th year. And our genuine concern is, are you going to get what you want? You have a dream, you want to go into an area. Maybe it's being gentrified, the regentrification is happening. You go into a project, you fix it, you sell it, you make a nice profit, but ultimately help put a family in that home, whatever that family is today. And we're part of that. That's what makes us tick. We get to make a difference. So we then started with fix and flip, went to new construction, bridge, and we really jumped on the DSCR product as soon as it came out because we believed in it. We know that it's a good product. It's very easy to do, and it is a make sense product. We lend our own money. We are not a correspondent, white labeler, anything in between. It's our money. We process our own loans, underwrite them. We do our own loan docs. We fund them. And on the construction, fix and flip, we'll typically portfolio those. On DSCR, we'll bulk and sell the DSCR products because we are not in the 30-year business.
Got
So
it. No,
short and sweet.
that's quite the impressive background. So it seems like
Yeah.
this is a perfect person to talk to about this topic. So let's just jump in, okay?
Mhm.
So for a brand new investor, can you explain a fix refi rent strategy and how the fix and flip loan pairs with the DSCR refinance?
Sure. Well, the biggest thing is, as I said, someone comes to us with a dream and they have an idea of ultimately it's primarily going to be profit. I want to buy it, I want to rent it, or excuse me, I want to buy it, renovate it, and then I want to sell it at a profit. And that has changed in today's marketplace a little bit because of just marketing time, how long they're not getting what they wanted. It's not worth what it praised for when they originally took it out. And they go and they do the renovation, they may list it for sale and it's not going anywhere, and they're like, okay, well, what are my other options with this? And realistically, if we're not involved with it initially, we'll step in and try and help them, but really what they should be doing is looking at the product process, excuse me, the project as a whole. What's it going to cost? What are my renovations? What are my carry costs to do this? When will I get done? and what's my profit going to be, and where is this going to put me in a tax base? If I talk to my accountant, how is this going to affect me? And a lot of times in today's environment, rather than taking it, a lot of people have a pride issue. It's worth this. I know it's worth this. I'm not selling it. And they just continue to carry it and they have it listed and it's not going anywhere. And, playing ostrich is really not a plan. They just put their head in the sand and we ask them, could you look at the equation a little bit differently? Maybe you should rent it for a year, get some value on it.
Mm.
If the market is, as you say, as we're saying, we're in 38, 39 states, it's going to change and it will. It's a new administration. It's taking a while for the effects of the economy to be felt. Let's see what the next year happens. And why don't you take a look at renting it? The DSCR is a great product because it just uses that property, that income based upon the cost of that income, the principal interest payment, possibly interest only payment plus taxes, insurance to hold it. And as long as the rents are more than the payment, you qualify. So you're not in a negative situation. So
Mm.
it's a make sense product.
Is there a certain percentage on that where it has to cover? Like, is it 100% of the rent potential, or is it?
Great question. Let me get back to the fix and flip part. When we do fix and flip, we have different percentages that we will lend individuals. Typically, if you have some experience, we'll lend 90% of the purchase and 100% of the repairs.
Okay.
So you need 10% down. But typically, what we're looking for on that, and it can change based on the value of the property, a 25 to 30% equity position. Okay. So that you know that you have that's your profit incentive in there. And for those who got in, couldn't sell it, that was going to be the money that they were going to make. But for the DSCR product, it's essential because we're not going to give you a 30-year mortgage at 100% loan to value. Those days are gone.
Hmm.
Max is going to be 80% on a rate and term refinance. So that's the percentage you're looking to max. The more you borrow, okay, the more your cost of funds are going to be. But if you are lower, your cost is going to be less. So if you're at the 70 to 75 or 80% loan to value, you're going to get you're going to qualify for a DSCR loan based on the loan to value percentage. From a debt service coverage ratio, which is DSCR calculation, it is just a 1-to-1 ratio. So for easy numbers, let's say your mortgage payment is $3,000 a month
Hmm.
and your rents are $3,000 a month, you're at a 1-to-1 ratio. Okay.
Okay.
If you're at $3,300 a month in rent and your rent, your more all-in mortgage payment, which again is principal, interest, taxes, insurance, flood
Okay.
insurance, HOA, condo, whatever it takes to
Okay.
hang your shingle is 3,000, you qualify.
Okay.
There's basically, we're lending our own money. We have 5 different institutions that we will end up transferring your servicing to, whether it be hedge funds or insurance companies. And each one has their own appetite for what they like, which is different products that we offer. There's basically several buckets, 0 to 0.75 DSCR. So for easy numbers, if you're renting for $1,000 a month and you have a 0.75 or below percentage, it's really you're losing money every month. Okay.
Hmm.
So in that case, your costs are $1,000 a month and your rent's $750. You're $250 in the red each month. You
Hmm.
can qualify with that. It is risk-based pricing, so your loan to value will be less and your rate will be higher because you're in the red every month.
Got it.
There's another bucket that goes from 0.75 to 1, which means you're still in the red every month. You're renting for $800 a month, but your cost is 1,000. You're $200 in the red.
Okay.
And that again is a different bucket. And then there's 1-to-1, which is basically, hey, it pays for itself. You're going to get very good pricing. You're going to get maximum loan to value. And then there's 2 other buckets, greater than 1.15, which means rents are, let's say, 1150 a month, and your all-in payment is 1,000. You qualify. You're going to get a little bit better rate. And then there is a 1.2 greater than 1.25 service ratio. So there's a number of different calculations that we look at that combine with credit score, loan to value, debt service ratio, and loan purpose. Is it a purchase? Is it a cash out refi? Is it a rate and term refi?
Okay. I definitely have some more questions about the DSCR loan, but what do lenders look for during the initial fix and flip approval? And what should a new investor prepare for before applying for one?
Great question. While we will take inexperienced borrowers, the majority of our borrowers have experience because the fix and flip in and of itself, watching HGTV, even if you watch thousands of hours going back to COVID, you're
Yeah.
not an expert in fix and flip. You're not. I'm
Yeah.
sorry. Um, because it takes a lot of nuances. You have to know how to work with the contractors. You know how to get permitting done. You have to know where you can save money. So really, when we're looking at it, we're looking at, does the borrower have a decent score? 660, 680 is probably our floor. Um, do we make exceptions to that sometimes if there's answers to it or reasons for it? But a fair credit score. And then it's experience. And the more experience you have, the more you've proven to yourself and to us that you're able to get this transaction done. And then the third thing would be cash. This is the individual we're looking at. So
Mhm.
it's credit score, experience, cash. And then ultimately it comes down to the asset. What are you buying it for? What is it going to cost you to do the renovations? And what is it going to be worth when you're done? So you have the as is value and then the after repair value. The difference, the delta in between your acquisition costs, your repairs, and for your calculations, the carry cost, plus what it's going to be worth in the end, that's where you have your equity and you have your options to sell or hold it as a refinance.
Got it. Got it. And I'm sure that's a little bit of a juggling act, essentially between experience, cash on hand, credit score, and the actual asset itself. So I'm sure if you maybe don't have as much experience, but you have a little more cash, or if you find a great deal, those kind of balance itself out, or do they weigh do one does one of those qualifications outweigh the others for new investors?
I would say cash is always king.
Hmm.
It always helps to have more because, from a lender's perspective, the equity position for us is less, which means we have greater security. But it definitely, all three of them help. There's no magic. The beautiful thing about what we do is we get to be creative.
Hmm.
So long as we can, to the best of our prognosticate, excuse me, um, how you're going, if you're going to be successful. So that really is the key component for us is, all these things, not, there's always a story to everyone, and everyone's story is a little bit different. So cash might be the biggest thing on one, experience might be on the other. We treat it as guardrails and it's kind of a flowing river, and we're trying to just get it in so that it makes sense. So at the end, you, the client, are getting what you want. And we, the lender, know that you're going to get that, which means we're protected because we're going to get paid off once you're done.
Got it. No, that's great information. So once the renovation is completed, they did the fix and flip loan. Um, what determines whether the investor qualifies for a DSCR refinance? Is that primarily the one-to-one balance you were talking about earlier, or?
Well, one of the other things that we really pride ourselves on too, before I get to that, is I didn't touch on this, is when you buy it, you want to renovate it, you possibly may want to sell it, you want to keep it as possibly rental, is what is that after repair value, which is one of the things that really is important.
Mm,
Now, we have a lot of people who come to us and they'll say, "Oh, the house is going to be worth $500,000 when I'm done. It's in bad shape now. These are my renovations, and here's my realtors comparables." Now, I'm a past president of the board of realtors. I'm a broker myself. I'm not impugning any realtors' reputations, but a lot of times they're not totally accurate.
mm,
And there might be some self-motivation because they want to get this initial sale and then get the listing.
mm.
So the key component to that portion of it is ensuring that when you buy it to renovate it, you give a very detailed scope of work. And then when you give it to someone like us who has been doing this a long time, we have typically handpicked appraisers, or at the very least with an appraisal management company that we know is very familiar with our type of business. And we get comparables that, based on your scope of work, choose other comparables that have the same quality of construction, and that the timeliness of the comparables make sure that the value is going to be there. and we can't guarantee it's going to be worth 500 at the end. But when your realtor gives us comparable sales that are in a different zip code, a different school system, or across the main thoroughfare, that doesn't make sense. So we're trying to ensure that that ARV is going to be correct so that you have the equity position to do what you want, sell it or refinance it. So that's really a key component because in order to get to the point where you say, hey, I want to turn it into a rental, you have to have that equity position. The maximum in the marketplace right now is 80%. So 80% loan to value. So if the house is worth 500, the max loan you're going to get is 400. The key question, which really should be if you say, hey, I'm going to buy this, renovate it, and hold it, the first question you should ask is, what is it going to rent for?
Mm.
And approximately, because you might be 6, 8, 10, 12 months down the road, what is my total payment going to be? Now, some of those costs are going to be fairly static. You know what the taxes are going to be. Now, they may adjust after the property's renovated, but you're going to get a snapshot in time of what it's worth. You could look at the neighborhood's tax, or excuse me, the neighbor's taxes to give you an idea. You can get a quote from your insurance agent as to what the taxes are going to be. So you know pretty much within a tolerance what that's going to be. What is not known is where a rate's going to be. So
Mm.
you could throw that in. You could be conservative and make it a 0.5% or a percent higher than market rates. So you know, hey, I'm going to owe 380,000 on this. The house is going to be worth 5. I'm going to get a loan for somewhere around 4 once I put my taxes, my insurance, because these loans have escrows, and I'm going to have some closing costs. So maybe I refinance for 395. What's my total payment going to be? Okay,
Hmm.
that's really the biggest. The first question is, do I have twofold? One, is it going to be worth the ARV value? Am I going to be in a good equity position? And then really, how much is it going to rent for? And that's as simple as the person for yourself. You can look at other market rents in the area, or you can have your realtor look at it and say, hey, could you let me know what you think rents are going to be in this area? Give me comparables so that you have a really good basis of whether or not does this make sense? Is it going to pay for itself?
Mm.
Last thing you want to do is do all these renovations, have the loan to value, but yet you can't qualify because your mortgage payment is more than market rents will allow.
Mm.
Really a key. That's really the first question. And again, as we were talking, you'd like to be at least 1 to 1, right?
Hmm.
The other thing is too, long term, the question is tax wise, how does it fit in with you? And unfortunately, in today's market, there's a lot of inflationary pressure, so rents keep going up and up and up.
Hmm.
So your mortgage payment, with the exception of taxes going up or your homeowner's increasing a little bit, the increase in rents are outpacing that. So you should be making more and more as time goes on because your mortgage payment should be pretty static.
Got it. No, that's great advice. It's definitely in the weeds a little bit, but it's definitely great advice for someone who's trying to get started.
It, it is, it is. And knowing these things up front, as everybody who comes to us, and that's where the experience factor comes in. I've already looked at this. I know where rents are going to be, within a tolerance. This thing's going to debt service. It's going to debt service, and I'm going to make $400 or $500 a month. And that's on long-term rents. You could also buy the property to be a short-term rental. It's an
Mm.
area near a college town. It's near the beach. It's at the lake, whatever it may be.
Yeah.
Those may be a little bit more subjective, and they could actually have higher debt service where you're getting even more money.
Interesting. Yeah, I didn't even think about the short-term rental aspect of that. That's um all right. Well, what are the biggest mistakes that you've seen some first-time investors make when trying the strategy, and what would your advice be to them as far as to how to avoid them?
Um, First is not doing the math, but let me go back to your last question too, because there's some other things that, and I want to get to that, but I want to make sure that everybody understands this too, is knowing the debt service. The other things is, besides the equity and the debt service, how else am I going to qualify for this long-term rental?
Hmm.
Um, Number one, do you own your primary residence? The biggest concern with our investors when we do this loan, when we go to sell them, is fraud. You can't qualify to purchase your own house based on your taxes and your insurance or your income.
Mm.
So do you own your own property? And if the answer is yeah, I own my primary residence, well, then it's pretty much okay, good, you can do it. If you're leasing a property or for whatever reason you live in your mom's basement, it's going to be frowned on. Doesn't mean it can't get done, but knowing the basis of how to get qualified for this loan is so important. And we're not accusing anyone of fraud, as we always say this. We're just looking at this and saying, hey, if you own your primary residence, cool, you've got it, you're qualified, you're ready to go. If you're leasing, great. But if you're leasing a 1,200 square foot house half a mile away from your purchase, and it is a 2,500 square foot house, how does that make sense? It certainly looks like there could be issues there. So owning your primary residence is key in it. Um, Having experience in it is good too. You can be inexperienced. You could be a first time investor getting DSCR loan. Typically, experience counts as you own one within the last 12 months. Inexperience, you can do it. There's a credit score restriction depending on what you're trying to do. Typically 680 or 700 score, and you're typically 5% loan to value reduction. So instead of getting 80% purchase, it would be a 75. Score would be you need at least a minimum of 640. And typically you need about 2 months reserves. So if your mortgage payment is $2,000 a month on the subject property, it's only that property, you need to have about $4,000 in savings. And that's kind of a rainy day fund. That could be cash in the bank. It could be 70% of any IRA, 401k you've got. So that helps you qualify too. Um, but I think I don't want to get too much in the weeds for you, but your next question is with the mistakes.
Yes, sir.
All right. So, um, what are the biggest mistakes? Can you repeat that to me just so I'm making
Yeah,
sure
yeah,
I'm
yeah. What are the biggest mistakes first-time investors make when trying this strategy, and what would your suggestions be to them to try to avoid those mistakes?
Great question. So this is where we try and forecast for our borrowers or prognosticate, as I said before, where it could go sideways. So it sounds trivial, but you need to expect the unexpected, meaning you have cost overruns because you're buying it to renovate it.
Mm,
During COVID, there was supply chain. God, we hope that never happens again, but there
yeah,
was issues that, you had longer carry costs, which cut into your profits. So
yeah.
expect the unexpected basically means that you have reserves. You have a contingency reserve. So if you're doing $100,000 in repair, we like to say conservatively 10 to 15% on top of that. So if you had 10 to $15,000 on top of that cash in hand to help smooth out some of those wrinkles, costs go up on the product, um, labor goes up, things of that nature. Um, and also just making sure your crews are there and getting the work done on time. Um, it's really we talked about the math and we talked about, knowing your DSCR, expect the unexpected, and timing is really the third thing. The typical fix and flip loan is going to be 12 months. Like ours typically is 12 months, interest only payment to keep the costs as low as they can with no prepayment penalty. Getting in and getting the work done and getting out is essential. And part of that is not only getting it done, getting it ready to, be appraised in the final condition. But then you need about 2 to 3 weeks to complete the transaction. It's DSCR loans do not take long. If anybody's telling you it takes longer than that, they don't know what they're doing. It's really not a tough process. 2, 3 weeks for at the most, to get it done, but that's really the time frame. And why is that important? Because if you go past your 12-month time frame for your fix and flip loan, you're going to be subject to extension fees. You're going to be subject to, which are costs. You're going to be subject to maybe increase in rates, default rate. And those are things that are unexpected. And you can control that by just completing the project. The sooner you get done, the less carry cost you have, the more opportunity you have to refinance and get out of it. Um, I would say the other part of it is in the fix and flip part, which a lot of people overlook, is not paying attention to your credit score. So you come to us and you want to do a fix and flip loan and fix and rent. You know, it may change over the timeline. And the fix for going to a fix and then rent, and you came to us and you had a 712 score. That's good credit. But during your renovation, you maximized your credit cards. Your credit utilization went high. So you had a $15,000 limit on Home Depot and you owe $14,250 when you applied to me. That in the scoring model for all three of the bureaus is going to reduce your score because it shows you're living kind of beyond your means. Now, it doesn't mean you have, but it's showing a propensity that you may fail. You may not be able to make these payments. So, not paying attention to your credit score as you're going along can really be a detriment to you.
Mm.
So, someone come to me, oh, we're ready to refinance. I've got a, 712 score, and we pull their credit and they've maximized everything and they're below our minimum score. Guess what? Now we have a problem because you're not qualifying.
Mm.
So if you're using a credit monitoring service, we recommend that. However, I would caution those are not credit scores. They are kind of a predictor.
Hmm.
So just be careful. Credit for us is good for 120 days, meaning I can pull it and then I just have to close the loan within 120 days. So if you know you're going to have a credit issue, not missing payments, but I got to buy a truck in 2 months. I'm going to have a credit pull. I know I'm going to maximize this card. My daughter's graduating. I
Mm.
have to get the funds. Those type of things. They're all just managing your debt. You're not doing anything wrong. When we do your loan, it's a snapshot in time of what your credit score. It is what it is.
Yeah.
Let's say that's one of the most overlooked, which is I did it all, cost me more than I wanted. And we pull the credit like, yeah, and you maximize every one of your cards and you now have a 612 score. I can't help
Mm.
you.
Yeah.
So the other thing that I would say is um, don't stop yourself from marketing the property before it's done. In today's environment, I mean, all real estate is local, but there is a great demand for housing.
Hmm.
And the ability to get out there and say the house coming soon for rent is key. A lot of people will wait till they have it exactly the way they want it. And while we understand that, and while data does show that it rents for more, getting it out there and having somebody saying, yes, I can rent it, and having somebody in place right away means revenue coming in right away because it's
Yeah.
costing you money until that happens. Um,
Got it.
it really is a key component. The other thing is too, when purchases, the houses can be vacant, no problem, no restrictions, no loan to value restrictions. On refinances, they can be vacant too, and I can get maximum loan to value of 80%, but you have to have the highest scores to do that.
Yeah.
So if it's vacant, well, it can still be done, and you may not need it based on what you owe and what the house is going to be worth. Um, is getting it out there and finding out what rents are. If at the very least, hey, I was right. It was going to rent for $4,000 a month. Or hey, it may go more than that, which is great. And it gives you, an idea of what you're doing. So I'd say as soon as you find it reasonable to rent it, do it.
Yeah.
And I would say one of the last things to do when you're doing the fixed part of it is don't over improve the property. If it's in your budget, and forgive me, if your spouse says to you, it would be great in here, canister lights all over the place,
Yeah. Yeah.
and it's $3,700. And while it may be great, you're not going to get any more rent for it.
Yeah. Yeah. That's not
If you
gonna.
want to live there, great. If you know that's what it's going to take for it to rent the most, and you've got the data to support it, great. Don't over improve the property and spend money you haven't budgeted.
That's great information. And I actually had a side question that you answered there. I was just curious if you had to have a renter in place already before they will before you give a DSCR loan, but it sounds like that's not the case.
No, and the reason for that is when you do the DSCR loan, if you're just talking about a single family house, you're getting the appraisal report is what's known as a Form 1004. That gives you your valuation. You've got three comparable sales within all the parameters to determine your market value. Okay, so that's what it's worth. Your second part is the 1007, which is your market rents. And that's typically three other rents. These are not sales, but other properties in the area and similar to yours in style, bedroom, bath, square footage, all that stuff. What did they rent for? And that's what we will use to qualify as your baseline. Hey, Market rents are $3,000 a month. That's what we're going to use to compare it against your mortgage payment. And if you have a renter in there, typically you get it done. I will get an appraisal done, and it's going to have market rents. And let's say the market rents are $3,000 a month,
Mhm.
but you're renting it for 3,500. You have a signed lease, you got a security deposit, and you can show me that you got that money went into your bank account. I can use the market rents to do that. Now, that leads you to another thing, which is, wow, I can qualify based off of what I'm renting it for, not what the appraiser said. Because appraisers are good at their jobs,
Mhm.
but an appraisal is an opinion of
Mhm.
value. It's not the actual marketplace. It's based on marketplace values. So if you can
It's probably
document that,
conservative too, I would think.
it just depends on the marketplace. I will tell you, in my humble experience, not to impugn any appraisers, if I give them a baseline and I say, "Hey, here's the lease, and this is what it's renting for," they look at what others are appraised for, or being rented for, but it kind of sets the market. Like, hey, the house is renting for 3,500.
Mhm.
Maybe this guy just did it on the cheap. They're not. They have a very systematic way of giving you the value. If they don't have if they don't have a lease, this is what it's leasing for based on the other ones. If I have a lease in hand and it's getting a little bit more because it's brand new, it's got another half bath, whatever it may be, you might get a little bit more value on it. That's why it does help. But no, it does not have to be leased, but you may be subject to some loan to value reductions and because the property is not leased at the time that you close the deal.
Understood. That's great. Okay, so in today's market, why might keeping a property as a rental be smarter than just fixing and flipping it?
Um, First thing is you may be in the market right now and it's just not selling,
Mm.
and it may not be the value you want to get for it or that it's going to be, valued at. We're in a market that is not unique. Rates are higher than we would like, but they are going to be coming down. So you can play the odds of, the housing becomes more affordable. So as I go on, I'm carrying someone's paying my mortgage payment, right? It's paying for itself. And then over time, cost is going to increase as far as, or the value, I should say, of the property. And hey, I could get my money out of it. I've got my money covered. I've got equity in it. It's growing and rates come down. It may even increase in value more. So, that might be one thing. Again, the positive cash flow. You might be making, it might not just be the 1-to-1 ratio. You might be 2-to-1. It
Mm.
could be renting, your payment could be $2,000 a month and you're making $4,000 a month.
Yeah.
That's real money that you can um, pay down the principal on, that you can put in your pocket, that you can do whatever you want with it, invest it, put it
Yeah.
towards your next deal. I mean, that's also a key component too. Um, and as you're holding it longer and longer, you're building more and more equity, as I said. So it's just really a personal tax strategy and where you're at in your life cycle of your investment for that property and your long-term goals.
That's great information. I
And
appreciate.
one of the key components with that too, I will say, is that you want to make sure these products, these are kind of what we call A minus products. So they're typically you can do a 10, 15, 20, 25, 30, even a 40-year mortgage, which I think this will fall into another question you're going to ask me. Um, but they are great products. But these are non-GSC products, meaning they're not backed by the government. This is just private industry. And the end securitizer who's buying these loans wants, or servicer wants a certain return. So one of the key components when you're doing these loans is knowing it's not like an FHA or Fannie or Freddie loan that do not have prepays. These loans typically have prepayment penalties,
Mhm.
anywhere from 0 to 5 years to 7 years. We don't do anything more than five. Probably the most used is a 3-year prepay. So you want to ensure that if you are going to keep the property and you've got a year lease on it, you're just going to ride it out, see where the market goes, grow your equity, that you know what your prepayment penalty restrictions are and that it's explained to you.
Hmm.
Now, we are very reputable in what we do. We give all of our terms up front and then you negotiate. Hey, I don't want a 3 year, I want a 2 year term. Okay. And the rates change. It's not really a loan to value issue. It's really a rate issue based on what we can offer you as far as the product because our back end investors want a certain return on their money over a certain period of time. So you can get a no prepayment penalty. If you take a 5 year prepayment penalty, you're probably going to get a little bit better rate. You are going to get a better rate. And then within those, there are hard and soft prepayments, also known as declining. So if you did a 3 year hard prepayment penalty, it could be 3% a year for every year. So for 36 months, if you sold it, you're going to get charged 3%. Could be 5%. That's why you need to ask these questions. That's why you need to be with someone who knows the products when you're dealing with your loan officer, making sure it fits your right goal
Yeah.
as to how long you want to hold the property. And then it could be a declining prepay, which is it could be a 3-2-1. So in the first 12 months, it's 3%. And this is of the principal balance of the loan. And then in the second, from the 12 to 24, 2%. And then from 24 to 36, it could be 1%. And one of the other key factors, if you are in that loan, you're saying, why would I want to keep this? Why do I want to do this? I'm getting 2 grand a month extra over my payment. You want to know that you can pay principal down if you want to. All of our loans allow up to 20% a year in principal reduction in your prepay period without kicking in any type of penalty.
Hmm.
So if you had a $500,000 loan and you paid $100,000 in one of the first 3 years, if you had a 3 year prepay, there's no penalty.
Hmm.
Why? Well, we're still getting paid and you're paying it down, and we know we're in a better equity position. It's one of the benefits of doing business with us is we want you to be successful. A lot of people in short-term rentals like to do that. You don't have to, but it's a personal preference.
That's great information. I mean, you really got to think of the whole project before you even get started, have your systems in place and really think it through. I mean, when you look at all these different points of
You
how,
have to, you have to be with, and that's so true. And you have to, it's like, whether it's estate planning, financial planning, planning for your kids' college, talk to someone who knows the product, the process, and more importantly, asks you, what are your goals?
yeah,
What are you doing this for? Did it change? Were you trying to sell it? Why do you now want to keep it? Okay, if we do that, what are the tax advantages? And ask someone who understands the loan side of it and also coordinate it with your financial planner, your accountant to say, hey, how could this most benefit me? And not just going to someone who says, oh, we do DSCR loans.
yeah,
Well, there's other people who do great business in the marketplace, very reputable. There's others who just, it's just another loan. And we don't do that. We want clients for life.
I get it. No, that's great. Now, this is another side question I just thought of. When someone's interested, if I was interested in getting a DSCR loan or starting off with a fix and flip loan, would I present the project to you, or is this something that I would work with you to create the, you know, all of the financials that are needed to present it to your company? Like, I guess my question is this something you help your clients work through as far as getting all the numbers, or is like, do you have a, how would someone apply almost to get this process started?
Sure. So for us, we do a lot on the web. So we know a lot of people we don't know, they just approach us. And then they come in and they say, this is what let's say they're buying the house is in disrepair. This is what I want to put into it. This is what it's going to be worth. So what our sales staff is trained to say, okay, so that deal will work in and of itself. It doesn't or it doesn't, or
Yeah,
it does. So no, there's not enough equity in this. It doesn't make sense for you to do this.
yeah,
That I don't care. That's okay. I'm going to put more money into it. And then the next question would be, okay, that's great, but why? Oh, I'm keeping it as a rental. Okay, now that's already explained it for us. If it
gotcha.
is, no, the equity does work, then our sales staff is trained to say, okay, well, when you get done with this, you could turn it into a rental or you're familiar with how that works. Because a lot of people they've heard of this loan, they may not be well informed about it, but they don't understand it's a very good loan. It is very simple to get done, but there's a lot of gears that have to mesh with it. So when they come to us, And they first say, if they're coming to us in your example, I want to buy and renovate it and I want to hold it. What we're going to say is, okay, we're going to look at the as is value. We're getting an appraisal done. It says, here's what you're paying for it. This is the renovations you're going to do to it. And this is what it's going to be worth. So that's your equity position. So we've got that in there. The next thing will be, okay, so based on your credit score, if you would like to turn this into a rental, you're going to have the equity because we're going to make sure you got 25 to 30% based on your what you're going to borrow and what the house is going to be worth. Okay, so there I've got at least enough equity in there to turn around and do a rate and term refinance. It may be worth more, and you say, hey, I want to take money out of it and I want to cash out on it. Um, you absolutely should, if you need it, take it. And at debt services. And they say, okay, well, I'm going to turn it to a rental. And we will say, okay, have you talked to your realtor about what market rents are? And because we're not in the business of telling you what it's going to rent for. I mean, I can give you an idea, but it's not, that's why you are paying for results from your realtor. And the realtor is going to do it because they know, hey, I'm going to get the sale and hey, I'll get the rental. And after, if he wants to turn around and not rent it anymore, and I did a good job, I'm going to get the listing. It's just smart business.
Hmm.
So we give them a game plan of, this is what you would need to get into the property. This is what your loan amount would be. This is what it's going to be worth afterwards. You will qualify for the DSCR based on loan to value. In order to give you a full picture, I need to know what it's going to rent for potentially. And
Right.
then we'll look at, as we said before, this is what property taxes are currently. Let's look at the neighbors who's very similar to you. That's what it's probably going to be. And then this is what your insurance is based on just a calculator. And yeah, it's going to debt service, and then that makes sense.
That's great. No, so I mean, it seems like it starts with a conversation, having a high level overview of your project and the scope of the project or what you're trying to accomplish, and then I'm sure once you can say you could do a potential qualification, and then you go get the details after that. Okay, that's
And again, the key component there. So we've known we can forecast what the property is going to be worth, and that's subject to market, fluctuations. We don't know where rates are going to be, but they haven't been outrageous.
mhm.
And all signs look towards pretty stable, maybe some declining. The one thing that I mentioned before is when we talk to them, credit score, credit score, credit score.
Yeah,
Please don't miss payments.
yeah,
Don't, if you know you're going to get this loan and you have an impulse purchase, do it the day after you take the loan.
yeah. Okay,
Don't do it before it,
yeah,
okay?
no.
Don't affect your credit scores. That's really what we try and say is that please keep yourself, if you change your situation on something that I can't control, I can't control it.
I know exactly what you're saying. My wife's been talking to me about buying a new car, and I'm like, well, we got this. We should wait a little bit until we figure out this loan. So I'm totally with you on that. I understand. Um, Rick, it's been great talking to you, and I do have one more question. It's a little off topic, but it's trending, and this current administration has been talking about it. So I just want to get your perspective on it because you're in the game and you got your boots on the ground. So, do you think the new 50-year mortgage is facing the same skepticism the 30-year mortgage did when it was first introduced?
Um, you know, I hate that. Well, I'll tell you the way it was explained to me. Um, Everybody wants to be a skeptic, and it's kind of the principle of social media. It's kind of a race to the bottom. So, oh, it's bad. It's the boogeyman. We don't want it. It's terrible. And there are some pluses and minuses. The 30-year mortgage came out around the Great Depression. I think memory serves me right. FHA, the Federal Housing Administration, was open in it was started in 34, and it was designed to promote home ownership. And 30-year mortgages were, it was the boogeyman. It was voodoo. I mean, I'll be dead by the time that's done. Now that's kind of this thing with this 50-year mortgages. But the math is the math is the math right now, which is we have a shortage of housing. It's pricey. The rates are what they are. And I think this is just looking at an equation and saying, okay, if we can't drive rates down, which is your cost of funds factor, based on what your term is, what you're paying, what other formulation could we do That would bring down the cost and make it more affordable. So, you know, it's the naysayers are going to say you're just going to be a permanent renter. This is akin to permanent renting. Well, that's not really true because you do, within the tax codes, or you're able to reduce your taxable income by the interest you're paying. You own something. It's the American dream. Um, but it is also, on the other side of that coin, is it's kind of the law of diminishing returns. Your payment on the 30 year is not much less than a 50 year, even though it is, but that might be what it takes to get you to qualify
Mm.
in today's day and age based on the cost of the housing. So it, it is, for me, right now, we're in a marketplace where we can only build so many houses. People sometimes are landlocked based on their jobs. There's not any inventory, and they need the ability to purchase something. So it will help. Now, there's others that will say that, you know, um, it's going to exacerbate the problem.
Mm.
So now I just made it a little bit cheaper, right? So now I can buy more. So it's really going to have a negative effect. It's going to be a zero-sum game in that, well, now I can apply, I can afford more. Well, now everybody else can afford more. So now I'm going to have to pay more. All real estate's local.
Yeah.
In my opinion, in the financing, if you educate the client on what they're doing, they need to know their own finances and they make reasonable, informed decisions for their life and their family, then it's an option. They don't have to take it. So I think it's going to be just one more tool to help them navigate, the landscape to get it done. It's, as I said, the 30 year was the boogeyman. No one took out a loan more than 5 or 10 years, and that was like unheard of. But if you can afford it, you can write it off. I think there's going to be some validity to it. It's a lower monthly payment. It's an easier qualification for the borrower. We'll see where it goes. As others would say, it's well above my pay grade to put this into a practical application, but I think
Yeah.
it's worth it. And you can do a 40 year right now with DSCR if you wanted.
Yeah.
How many have we done? Zero.
Okay. Yeah. Okay. Well, no,
But
this
you
is
can. The other thing is too that, and I will bring this back to DSCR, is you can qualify interest only on these. So it's a great product that allows you to do it. You can do up to 80%. Um, and it's a good thing. I will say one other thing too, and this might be something um, that a lot of people touch. You can do second mortgages for DSCR too. So if you're an investor and you have a property that has equity in it, and let's say you want to buy another property,
Mhm.
and you're short on cash, you can cash out to 80% of your home's value. Just has to qualify to 1-to-1 ratio. The property has to be leased. You can do a loan amount of minimum of 75,000 because they want our investors back in when a return on it. And you can do a loan up to $750,000.
Mm.
There's really no negatives to it because the property still has to qualify, meaning the rents received can be no more than the first and second mortgage together. So it's still at the very least a zero sum cost basis, or it has to be positive cash flow. And it opens up a lot of doors for investors who see a project, but they just put it into another one and they're a little bit light on cash, but it makes sense. And they've got a couple $100,000 in equity in a property, they might use it. So,
That's great. Thank you for sharing all this knowledge with us. Definitely appreciate your perspective. Um, for everyone that's still watching, please like this video and subscribe to our channel. It helps our channel grow. Um, if you want to look for foreclosures or you're in the market and want to understand what's going on, make sure to sign up for our free foreclosure alerts at foreclosure.com to stay ahead of the trends. Until next time, I'm Tim Jones, and thank you for joining us today.